welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Tuesday, May 24th, 2022, and I'm pre-recording this Trading Places Live for Tuesday, well, for today. I'm getting this started just a little bit early this morning. Futures right now are pointing lower, so it does look like we're going to get off to a rough start. And this follows up a pretty bullish day on Monday. We saw a nice rebound day. Yesterday, the market was up throughout most of the day. A little bit of a pullback in the morning, but otherwise, mostly higher throughout the day. Still didn't feel right though, and I'll go through some of that with you. It's still, the market just doesn't seem like it's found its bottom yet. And it's going to make it for difficult trading until it does, because volatility is high. So you really just can't trust these moves to the upside. And that's really what, happened this morning. In my opinion, is, we're in a downtrend. And so you think you got a pretty nice rally going, and all of a sudden, all the gains that you made from yesterday pretty much wiped out the next morning at the open. And we've got to, deal with this probably throughout maybe all summer. Hopefully it won't be all summer. Maybe we'll, I've been thinking maybe we bottom in June, but I wouldn't be shocked to see September. I mean, the worst time of the year historically is from mid-July through the end of September. So, looking for a bottom in June may not be realistic just based on that historical fact. Anyhow, there's a lot to go over. Let me walk you through today's agenda. Going to start off with the daily market recap, then jump into talking technically, do a little momentum sleepers, different way of looking at this, but we'll go into momentum sleepers. Did you know? Got an interesting question for you. I'd love to know how many of you know the answer to this question or have an idea. Maybe you can leave something in the comments. Let me know what you think. Anyhow, then we'll go with earnings spotlight, and we'll wrap up with the 3 you must see. Before we get into any of that, though, I want to take you over to Earnings Beats. For those of you who are new to Earnings Beats, if you go to earningsbeats.com and then just simply scroll down, you'll see we have a free newsletter. Name and an email address, all it takes. No credit card required. You can unsubscribe at any time. We have lots of folks in here. When we do free events, we reach out to this community. So there's other reasons you want to be part of this digest newsletter, not just to actually receive the digest, but also all the free events that we do throughout the year. We do a number of them. And so we'll make sure you get an invite and room instructions for those. But it is a newsletter published 3 times a week, Mondays, Wednesdays, Fridays, normally out by about 8:30 in the morning. Very, very easy read. If you only have a couple minutes with your coffee in the morning, this is perfect. Probably 2 paragraphs in a chart. That's almost exactly what you're going to get 3 times a week, and just give you something to look at. Maybe it's an earnings related chart, something that piqued my interest relating to earnings. Could be showing something relative strength, could just be featuring an industry group or the S&P 500, pointing out something on the charts. But I try to make it educational. Sometimes, you may want to trade it. It's completely up to you. Of course, that's your risk. But I think you'll enjoy the newsletter. And again, it does give you the ability to come into all of our free events. Also, just want to point out, 1 more week to go. I think next Monday is the end of our spring special. So anybody who's interested, if you like the show, if you like my blogs, I think you'll love our service. But you can try it out for 30 days for free. We've got a big event coming up on Thursday talking about historical trends. That will be a members only event, but all it takes is a 30-day trial, and you're in. But if you do come in, check out the service, and you like the service and you want to subscribe, this is the best deal you're going to get all year. So that's why it's a great time to come in and check things out. Anyhow, if you go over to earningsbeats.com and just click on this, it'll give you a little bit more information on our special. All right, daily market recap. What did we do yesterday? Well, we rebounded. Dow Jones Industrial Average up 618 points. Nice day. S&P 500 up 72. NASDAQ up 181. Mid caps up 25. Small caps up 12.5. So on a percentage basis, the strength actually was in the Dow Jones. S&P 500 trailing right behind. Small caps and mid caps actually lagged on a relative basis based on their percentage gains. Financials. Financials up 3.25%, led all sectors. Banks had a big day. Energy up almost 2.2%. Technology 2.3% higher. Staples a little more than 2% higher. But I said that there were some signals yesterday that just didn't seem right to me. One of them, discretionary stocks. What the heck is going on with discretionary? I mean, look at consumer staples have fallen apart in the last month, but consumer discretionary, that just added to what was already going on earlier in the year. But then we finally have a rebound day yesterday. Staples goes up 2%. Discretionary goes up 0.75%. Discretionary should be leading staples when we have big days to the upside. Just another reminder of the issues that we have in the market right now. I look at the discretionary versus staples. I actually use that ratio, the XLY:XLP, as one of my sustainability ratios to try to figure out when the market goes up, is it a sustainable rally? And what it told me back in December was no, it was not. It was clearly not. I mean, that ratio was going straight down in December while the stock market was going up. Yesterday, we have a big day and the ratio takes another dive. This is not the kind of action we want to see if we're talking about marking a bottom. Now, does it mean that we're going to go down another 30% on the S&P 500 and this is going to be a secular bear market? No. This could change tomorrow or start to change tomorrow, maybe today, who knows? So no, I wouldn't be looking at it like that. I'm looking at it relative to what the S&P 500 is doing. I'm not using it to forecast what the S&P 500 necessarily is going to be doing 6 months from now. We'll have a lot of different things to look at there. I mean, the trend itself will tell us that. If the S&P continues to trend below the 20-day moving average, you're not going to really want to be in. And you can see right now, that's exactly what we've been doing. So, but anyway, the relationship here between these two sectors, in my opinion, is really an important one. And when I see both these groups going down as hard as they're going down right now, that tells me that we've got a recession either at hand, coming, but I think it's at hand. I think we already started it. There's some saying, yeah, I could see that we're going to might have a recession in 2023. Well, they're not looking at the charts right now because you've got consumer spending, which is 2/3 of the GDP. And here's where they spend: staples and discretionary. And look at the charts. I mean, I'm not making this up. This is what Wall Street's doing. Wall Street's selling these groups. Why are they selling these groups? Why did they sell discretionary over staples back in December? Why were they rotating out of aggressive areas and into defensive areas? I don't care why. I just see that they're doing it. Call it what you want. I mean, I talked about the surge in inflation. I talked about higher interest rates. I talked about recession, the potential recession at the beginning of the year. That this ultimately, we're going to change from talking about inflation to talking about a recession. Why? Because when we get a recession, the demand goes down. When the demand goes down, inflation naturally is going to go down. Inflation is too much demand and too little supply. That's like the definition. That's recession 101. Well, inflation 101, probably recession right on the heels of it, at least in this case. But no, I mean, we've got to continue to look at the charts and what the charts are telling us. The charts are telling us that we've got a recession at hand. And when the only reason we're not talking more about it is because it's more, in the know to talk about inflation right now and higher interest rates and the Fed. But once the media doesn't have to talk about that bad news because things start getting better, recession is going to be all over everywhere. By the time the media is all over recession like a dog on a bone, the stock market will have bottomed. We'll see. That's my story, and I'm sticking to it. All right, 10-year Treasury yield. Well, this morning when I looked, the yield was down. Yeah, right now it's down about 5 basis points. So it's down to about 2.81%. And I love it yesterday. I mean, you just can't make this stuff up. The headlines yesterday that I looked at, yields were up and financials were up. And the headlines were, financials are up because yields were up. And financials love higher interest rates. It's better for their profit margins. And most of the time it is. But what they don't tell you is that actually financials have been leading now for about the last, 6 trading days relative to the S&P 500. Yields have gone down during that period. Now, in prior moves, financials, you can see the interest rates going up. Financials led the S&P. Rates going up, financials led. Rates going up, financials led, at least for a while. Then you can see it kept going up, and they didn't. During this move, yields went up. During this move, yields went up. During this move, yields have not gone up. Yields have come down. But I just thought it was so funny to see headlines talking about yields rising, and that's what's driving financials. Where's everyone been that's talking? Whoever wrote that, where were they back from February till now, when yields have been going up and financials have been underperforming? I mean, it literally, these headlines, these folks that write these headlines don't follow the stock market. It's almost like, okay, the market went up. Give me I need something. Give me a headline. Somebody come up with something. They don't follow this stuff. They don't know what they're talking about. So frustrating. And the reason it's frustrating for me is I like to educate. I like to teach folks about the stock market. What makes it go up? What makes it go down? What we have to worry about. The media, unfortunately, you got a lot of folks that don't really follow the stock market closely. They get their stock market news, quote unquote, from the media, which is scary. You're never going to learn anything from the media. The media wants headlines. That's what the media wants. Give me the headline. Give me a headline that can attract the most clicks. That's what I need right now. Give me that headline. Anyway, I could spend all my shows on the media. Let's move on talking technically. So the S&P 500, I mean, I said yesterday in my show over at Earnings Beats, we had this big rally on Friday afternoon. We came back up. We held this 3,900 support level. 9 times out of 10, when you see that kind of reversal, you're going to go higher the next day. Maybe 8 out of 10. Maybe it's not 9 out of 10. Maybe it's 7.5 out of 10. Okay. Don't hold me to this. But when you get that long tail, that means that there's buying late in the day. We had a breakdown intraday. Who in the heck would possibly be buying a breakdown in a market like we've been in? There's only one group, market makers. I certainly wouldn't be buying a high volume breakdown middle of the day. We could have been in for a Friday sell-off like crazy with a big gap down Monday morning. I'm not going to do that. But once you see that rally occur, then you have a pretty good idea that market makers are long. And when market makers are long, guess what the market usually does? It usually goes higher. And so that's what we saw yesterday. Probably, and after the rotation we saw, and I pointed that out just a couple minutes ago with discretionary and staples. I mean, after that rotation, it looks like probably we're, setting ourselves up for another move to the downside, which futures are pointing to. Now, whether or not it lasts, I don't know. A lot of times, you get these big reversals, you get a little churn, and then you still, after a big move down, a lot of times you just need a little rally, and we've had a huge move down. So I really wouldn't be surprised even after a gap down if we went back up. But in this volatile market with fear building, I wouldn't be surprised if we also gap down and just exploded to the downside. I mean, I pointed this out yesterday, but you can see this big reversal right here on April 25th. Look at the next day, went to a new low. So it's not always a great signal. And even when it is a signal, there's no guarantee it's going to last for 7 or 8 trading days. I mean, here, basically, we had a big reversal and we had one up day, and then we never really went any higher. Here, we had a reversal. We went up 2 days, then right back down. So don't be thinking, at least I would not be looking at this as some kind of major bottom where we're going to go up for 10 straight days, 20 days, and be back up over 4,300, go through the 50-day. I mean, I'm not looking for that at all. If it happens, we'll deal with it as it happens. But right now, that's not what I would be expecting. I'd be expecting maybe a 20-day test, maybe the recent high in this breakdown. So 20-day test first, and then maybe 4,100 to 4,150 would be kind of an area of resistance. And honestly, I don't see it going up much more than that before moving back down to new lows. All right. Take a look at the home construction. I didn't mention it, but we do have new home sales coming out later this morning. And any kind of the economic reports surrounding housing, it's been very poor, very, very poor of late. So they're expecting a small drop in new home sales. Let me give you that number. All right, so March new home sales came in at 763,000. April new home sales are expected to drop to 750,000. I wouldn't be surprised to see them drop further than that, just because every report seems like it's missing in the housing area. With rates going up as much as they did during April, I wouldn't be surprised if April new home sales dropped more than expected. But the home construction area is building a lot of this negativity into price action. I mean, we've dropped from 1,750 down to 1,100. How much more do you think we're going to go? I don't think we're going much lower in home construction. I really don't. I think interest rates will peak out, and I think we'll start to move back down. I don't think we'll get back down anywhere near the lows that we had. I think those are probably gone, and probably gone for a generation or two. But I wouldn't be surprised if we pulled back and saw rates drop, maybe get back half of what we just moved up in rates out. That wouldn't surprise me. And if we do that, then this is probably a great time, during this period to get into home construction. We do have positive divergence, by the way, PPO higher, and you can see price action lower. I mean, I do question it a little bit because we had a 50-day test in between. Normally, I like to see those set up with just 20-day tests. Once you get to the 50-day and you get back close to that center line, it's almost like a reset at that point. So I don't know, there's some mixed bag here, but the fact that we've already dropped more than a third of the market cap or of the value of this index, that tells me we probably have most of the selling behind us, in my opinion. I mean, could we go below 1,000? Sure, we could. I don't think we will, or if we do, I think it'll be barely. But this is an area that's very volatile, very cyclical in nature. And so right now, it's not good, and we'll see how low we go. All right, let's move on to momentum sleepers. All I wanted to do here, I pulled up the S&P 500 and I did a 1 month. I looked back over 1 month. And what I'm thinking from a momentum sleeper standpoint, normally the market's going up and I'm thinking about pullbacks, momentum sleeper. Here, though, I mean, we've been selling off. I mean, if I look back just over the last month, we've had a pretty big sell-off in the S&P 500. I mean, what was this? April 21st right there. And what are we, May 23rd, 4th right now? Yesterday's close, May 23rd. So that's about the month that we've had. It's been 10% lower on the S&P 500. So when I think about momentum sleepers, I'm thinking about maybe stocks that have been downtrending that all of a sudden took a little break and maybe even were flat last month. Well, if we move back over to this summary, you can see most of these at the top are energy, utilities, materials, healthcare. These are groups that have actually, for the most part, done pretty well. I would be thinking in terms of momentum sleepers if I saw technology stocks in here. These are stocks that are actually moving up over the last month while the market's gone down. If these are in downtrends, this could be their sleeping period. They're hibernating right now before another leg down, maybe. So you'd have to go and look at the chart. Well, this one actually looks like with a gap up, maybe we're going higher. Now, if we can't hold on to gap support, then this will turn out to be a momentum sleeper, and right back down we go. So watch that gap support level. The other one, here's a software company, PTC. This one, another big gap up with earnings coming back down. Same kind of a deal. This one doesn't look quite as good to me. Let's see what it looks like on a relative basis versus software. Well, it actually does look pretty good versus software. I mean, so this is one of the leaders in the space, and you want to see the leaders doing well. If the leaders start to fall apart, where does the market turn? So yeah, PTC would be one I definitely would keep an eye on. If we come back down here and move to a new low again, that'd be very bearish, now, obviously for this stock, but I think it'd be very bearish for the software group as a whole. If one of your leaders can't hold on to gap support from a solid earnings report, then you got problems. AD line, by the way, doesn't look too bad in this stock either. Set a 52-week high back in March when the stock was near a 52-week low. So it looks like Wall Street's using this weakness to actually accumulate a little bit. But there'd probably be a lot more around the break-even point if you go in here. Or maybe what you could do is just sort this by technology. And then you get a better sense of, some of the stocks. How about some of these semiconductor stocks that have shown a little bit of strength over the last month? Let's look at MCHP. Yeah, I mean, to me, that's like a momentum sleeper. Downtrend, back up, downtrend, and now we're just doing the sideways consolidation. This is a bear flag. I mean, if we break down below that 63 level, MCHP, I mean, you could probably see the stock back down around 50. But I mean, that's an if we break down. Now, that's what I would expect, given what I think is going to happen in the market. And looking at this chart, I believe we're going to break down. I think all of this sideways consolidation, big volume breakout above about 70.5 would be good. Otherwise, looks to me like we're probably just biding our time before a breakdown. All right, next up. Did you know? Now, I pulled up the S&P 500 basically since 1950. So this goes back from 50 to 22, 72 years. Now on here, I've listed the 5 days of the week: Monday, Tuesday, Wednesday, Thursday, Friday. And I told you I'm doing a historical trends webinar on Thursday. Here are the annualized returns of each of the 5 days of the week since 1950. I mean, we think, in the stock market, every day is created equal. We don't really think of, maybe some of us don't think of historical trends, like there are actual patterns if you study history. Well, I've studied history and I know there are actual patterns. I don't think it, I know it. Look at these annualized returns, these 5 annualized returns in these 5 days. Which one goes with which day? I mean, we've got one day since 1950. One day has produced annualized returns of almost minus 14%. And here's another one over here that's produced annualized gains of almost 20%. That's a 34 percentage point swing. And this is all these days for 72 years. These are big sample sizes. You can't just blow this off and say, well, the sample size was too small. That's not at all the case. These are large, very representative sizes, sample sizes. So what gives which days which? Do you know? As a trader, do you think it would be helpful to know which of these days, Monday through Friday, has produced minus 14% over 72 years? You like to go long? Think it would be nice to know which day is almost 20%? This is what we're going to be talking about. Not just this, but this is just one thing that we'll be talking about on Thursday at this historical trends event. You got to know this stuff. I went back and studied history because of my background. I'm a CPA. I was in public accounting for 20 years. I just like to analyze. I love analyzing, trying to find what makes things tick. And when I looked at the S&P 500, and I could go, it's a long story, but based on my auditing background, I just had a feeling that there were a lot of historical trends in the stock market. And I was right. And you got to know what they are. You've got to know what they are. Another favorite of mine, just to give you maybe a little bit more background on what we'll be talking about. But one of my favorite stats is there's a 10-day period, well, maybe 10 to 12 day consecutive day period of the calendar month that has produced essentially almost all the S&P 500 gains since 1950. 10 or 12 days out of the entire calendar month. All the other days, it's almost break even, slight gain. You got to know these 10 to 12 days. You have to know them as a trader. You got to know when the market has that tendency to go higher and when it has the tendency to go lower. Again, I'll be talking about all of that on Thursday. So again, I'll point out one more time, we have a special. Come over, check us out for a 30-day free trial. Come to the event on Thursday. You don't have to pay anything. We have a 30-day free trial. You have to give a credit card, but we will let you know at the end of the period that your time's up. We're not hoping you sign up and forget about it. We don't want members who don't like our service. Come check us out. And then if you like it, if you like the service, then you can take us up on our spring special. Anyway, I hope you will. All right, so let's take a look at let's take a look at Zoom first. Zoom reported earnings yesterday. Actually beat, very strong report. But I wrote an article, you see the stock up 3%. It was up 20% yesterday after hours, right after the report. Now it's up 3%. It's not about Zoom. It's not about growth stocks. I wrote an article not too long ago, just a few days ago. If you haven't seen it, go to Trading Places, my blog, and then right here. It's not you, it's me. It's not Zoom. It's growth stocks in general. That's what I was writing about. It's that breakup excuse. It's not you, it's me. That's what growth stocks have been saying for the last 6 to 8 months. Each individual stock that goes down, it's not you, it's me. Anyhow. So the three you must see, let's go through these pretty quickly. First one I just want to show you is JPMorgan. We did break above the 20-day yesterday. Banks had a great day. We've done this before, though. So just be careful. We remain in the downtrend. Yeah, interest rates went up yesterday. Okay, they've been going up. Where's JPMorgan been? Going down. So do I buy into that interest rate theory for one day? No, I don't. The futures are down. Be careful here with JPMorgan. Others in this space, same thing. Here's Wells Fargo getting back up above the 20. I like Wells Fargo, but we've got to hold on to this $41 support area. If we don't, I'd be very careful. And last one, I'll point out Citigroup. Same thing, moving down, except Citigroup got through the 50, but it too still has price resistance to get through. I'm going to say 53 probably is a level I'd be watching, 53, 54. That's about where we were yesterday. Couldn't get through, though, on the close. Let's see what happens today. Anyhow, that's it for me. Appreciate everybody tuning in. Check out our webinar on Thursday. We'd love to have you sign up for a free trial. Have a great day, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.